Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everyone. This is the Northbound Wealth Podcast, weekly market insights with your host, Brent Foster. We're going to dive in to last week's review, and then we'll talk about what's going on in current markets starting March 16, 2026. The markets weather a volatile week. That's the headline. Choppy markets. The S&P 500, the index declined 1.60%. Its third consecutive decline last week as oil prices continue to climb amid turmoil in the Middle East. The index ended the week at 6,632.19. It is down 3.6% in March and has fallen 3.1% this year, but is still within the 5% levels of all-time highs reached on January 27th, 2026, despite everything going on in the world. The NASDAQ Composite Index lost 1.26%, closing Friday's session at 22,105.36. The Dow Jones Industrial Average fell 1.99%, closing the week at 46,558.47, down from the February 6th closing above 50,000 historically for the first time. The MSCI EAFE index, which tracks developed overseas stock markets, slid 2.28%. So the Middle East. As the U.S.-Iran war neared the 2-week mark, most sectors of the S&P 500 fell. Markets got a volatile start to the week with stocks falling and oil prices rising as commercial maritime traffic heading out of the Persian Gulf through the Strait of Hormuz remained at a virtual standstill. But stocks rebounded late in the day after the White House said the conflict may end sooner than expected. The energy sector bucked the decline, but Brent crude, the global benchmark, reached its highest settlement value since August 2022. The climb in crude oil futures came even as the U.S. began allowing countries to buy sanctioned Russian crude already at sea. Adding to investors' concerns, government data showed fourth quarter gross domestic product was lower than previously estimated amid weaker consumer spending and a larger downturn in exports. The report showed U.S. real gross domestic product came in at 0.07% annualized growth rate in the December quarter. Wall Street expected growth to match the initial 1.4% estimate, according to a survey compiled by Bloomberg. With all the updates on the Middle East conflict, it was easy to miss other news last week. Wednesday's report that the CPI remained unchanged in February over the prior 12 months was good news, but it was the last bit of inflation data before the conflict in the Middle East began. Friday's personal consumption and expenditures index, the Fed's preferred inflation measure, showed that consumer prices remained sticky in January. Investors largely took this report in stride because delayed reports tend to lose their impact with time. The financial sector had the largest percentage drop of the week, falling 3.4%, followed by a 3.2% loss in industrials and a 3% decline in consumer discretionary. Healthcare, materials, real estate, communication services, technology, and consumer staples also fell. Fiserv and Global Payments were hit the hardest in the financial sector, sliding 10% each. FactSet Research Systems shares fell 9% as Deutsche Bank cut its price target on the stock to $275 per share from $335 per share. Top decliners in industrials included Axon Enterprise, down 14%, and Equifax, down 11%. Ulta Beauty was the worst performer in consumer discretionary, tumbling 17%. The beauty products retailer reported fiscal fourth quarter earnings per share below analysts' mean estimates and forecast fiscal 2026 EPS below the street's views. Just two sectors managed to post weekly gains. Energy climbed 2.1%, while the utilities sector eked out a 0.4% increase. Occidental Petroleum had the largest percentage increase in energy, rising 6.8%, followed by a 5.5% gain in APA. Both stocks received price target increases from Barclays. So this week, we're going to have Dollar Tree, Micron Technologies, FedEx, and Carnival among the companies releasing quarterly results. We'll be tracking that for you. Economic data will include the February Producer Price Index, as well as February's industrial production and pending home sales. Also, the FOMC will hold a 2-day meeting, concluding with a decision on interest rates. So we'll be watching to see if they're going to lower interest rates or raise interest rates, given the market environment and the economy. Of course, we expect them to do what's in the best interest of the public, actually. Interestingly enough, we'll see. Weekly market insights. So the 1-year trailing number, I just want to remind everybody, even though there's a lot of noise going on in the markets, that the NASDAQ over the last 1-year trailing is up 27.23%. The S&P 500's up in the 1-year trailing 20.69%. Dow Jones Industrial Average is up 14.86% over the last 1-year trailing number. And the MSCI EFA Index is up 23.21% over the 1-year trailing number. So sometimes we can lose sight of how much the markets actually went up 3 years in a row. We're having a little bit of volatility here due to what's going on in the Middle East, but a lot of folks are still in the black over the last many years. Okay. 10-year treasury rate is at 4.28%. So we've had a uptick in yields. 1 month change, 5.94%. So yields have gone up. 3 months ago, yields were at 4.19, and a month ago they were at 4.04. So you saw a pickup back into interest rates. Interesting. All right. So we'll be following industrial production, capacity utilization, FOMC meetings day 1 and 2 this week, weekly jobless claims, employment cost index, and new home sales. There's some of that stuff going on this week. So tax tip of the week: couples who work together, tax together. When a household starts a business, couples learn about the tax responsibilities associated with it. There are some things to consider when working together. Here are a few things to consider, okay? You should first establish whether you have a partnership business where both spouses have a equal say in the affairs, services, and capital of the business, or an employee-employer relationship where the one spouse substantially controls management decisions. These relationships have different tax situations. If there is an employer-employee relationship, the second spouse, the employee, must be subject to income, Social Security, and Medicare taxes. You may also need to file the U.S. return of partnership income form if there is a partnership relationship versus an employer-employee relationship. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. This tip was adapted from irs.gov. Stay tuned for the next segment. I just recently wrote up a letter to young professionals out there. So if you're listening to this podcast, you're a young professional, I've got a question for you, and I put out a letter for you. Tired of your money sitting on the sidelines while life and inflation passes you by? So let's say you're crushing it at work, but your net worth, what about it? Still playing catch up, saving for a down payment to buy a home or level up for your growing family? Or are you one that rents, and rent's basically a mortgage? You got student loans. You got some FOMO on individual stock gains. So like fear of missing out on what's going on in the markets. It's like passed you by. Stock market index gains, or you don't even know where to start. You're kind of like, I don't know, I'm kind of doing these things, but I don't have a written plan. Does that kind of sound familiar? Well, I'm introducing myself, Brent Foster, as an independent RIA who specializes in people just like you. You're ambitious, you're busy, you're done with generic robo-advice or pushy brokers who don't get it or don't understand your situation. I don't wear suits necessarily. no stuffy offices, and no let me sell you this annuity. What I actually do is I work at turning your scattered finances, your 401k, your side hustle income emergency fund that's too small, into a clear plan that actually moves the needle. Help you invest smarter without gambling on your future and on the next hot meme stock or sitting there betting on Kalshi. I align your money with what matters to you, whether that's early financial freedom, investing with a serious strategy tailored for you, buying that first home, or building real wealth without selling your soul. Cut through the noise so you can stop second guessing every market dip. Should I buy? Should I sell? What should I do? Young professionals I work with are paying down debt faster without feeling broke, maxing out tax advantaged accounts in the smart way, finally sleeping better knowing their money is actually working as hard as they are. The best part, my fee only structure means I'm on your side, not chasing commissions. So if you're interested and ready to stop guessing and start building, you can book a free 30-minute discovery meeting, no pitch, no obligation. And we'll take a look at where you're at, where you want to go, and map out a couple of 2 to 3 real moves that you can make this quarter, hopefully get you on the right path. So if you're interested in that, you can go out to my website under services and schedule a discovery meeting. You're already investing your time in your career. Isn't it time your money caught up with you? So let's make your 20s, 30s, and 40s and beyond financially unstoppable. Cheers. And thanks for tuning in to the Northbound Wealth Podcast. Hey, everybody, there's an article today, 3/16/2026, which is March 16th, 2026, by Jed Graham of the IBD, Investors Business Daily. And he is talking about the oil price slide from Iran as it opts for porous Strait of Hormuz. So that's the headline. Oil prices fell back near $95 a barrel in U.S. futures markets Monday as Iran's Strait of Hormuz strategy became clear, with the hardline regime allowing passage of ships bound for Pakistan, India, and China. The pullback in oil prices is allowing the S&P 500 to rally Monday morning, even as the U.S. struggles to find partners for an effort to guarantee safe passage through the key shipping route. A massive oil price shock isn't in Iran's interests, BCA research chief strategist Felix Antoine Vizina Poirier wrote in a Friday analysis. A porous Hormuz implies Tehran is signaling a resolve without provoking its partners, he wrote. Fully closing the strait would invite a multinational effort to reopen the passage, he said. Tehran's sweet spot, he said, is causing enough of a crisis for the U.S. and its partners to deter future regime change attempts without causing maximum disruption that makes Iran's actions untenable. Oil prices. The U.S. crude oil future price for April delivery was just above $95 a barrel late Monday morning, down 3.8% from Friday's settled price, according to CME Group. However, declines were somewhat more modest in contracts for subsequent months. Future pricing shows crude oil prices staying around $80 a barrel through the September contract, which suggests concerns about the conflict lingering. U.S. natural gas futures prices have yet to rise significantly amid the war. However, natural gas prices in Europe jumped 2.5% on Monday and are up nearly 70% since the war broke out. India said on Monday it was awaiting the arrival of more than 40,000 metric tons of liquefied petroleum gas on a ship that embarked from Qatar, according to the Associated Press. Shipping tracker Marine Traffic said a tanker transitioned through the Strait of Hormuz, carrying oil from Abu Dhabi to Pakistan. Iran exports rise. So Iran is reportedly transporting more than 2.1 million barrels of oil a day through the Strait of Hormuz, en route to China, even more than it exported before the war. Roughly 20 million barrels of oil per day, or 20% of global consumption, typically pass through the Strait of Hormuz. The near shutdown of that key shipping route had led Iraq, Kuwait, Qatar, Saudi Arabia, and the United Arab Emirates to reduce output as they run out of storage capacity. Iraq cut capacity to just 1.3 million barrels of oil per day, down from 4.3 million before the war broke out. However, the actual shortfall in oil exports is far less than 20 million barrels. In addition to Iran's own exports and the ships to which it is granting safe passage, Saudi Arabia and the UAE have boosted the amounts of oil sent via pipeline for transit through the Red Sea by 6.5 million barrels a day. As a result, more than half of the oil that typically transits the Strait of Hormuz is still finding outlets. So, the S&P 500 today, which is Monday morning, rebounded 1%. I cannot wait to not talk about the Strait of Hormuz, actually. I'm already tired of it. Anyway, on to the next segment. Here are 3 numbers every woman should know. It's out on my blog if you want to read the article. Otherwise, you can listen in. What do these 3 numbers have to do with women? The number 5, the number 45, and the number 59. So, key takeaways. How much wealth are women on track to control in the next decade? And why does that matter? What does the life expectancy gap between women and men mean for how long money needs to last? How common is it for women to be primary earners, and how should that change their insurance investment and retirement strategy? And why does the average age of widowhood around 59 matter, even if it feels, quote, too young, end quote, to worry about? Why these numbers matter? A quiet shift is happening. Women are building their own wealth through careers, often serving as the primary earners in their families and inheriting assets from their parents and spouses. Meanwhile, women are living longer and, in many cases, making financial decisions independently later in life. The story of women in finance can be told today in 3 numbers that are shaping many of their lives: 5, 49, and 59. The story these numbers tell us is that women are likely to oversee more wealth for longer periods and for more people than previous generations. Financial strategies today should reflect this emerging reality. Okay, so the number 5, the extra years money may need to last. So, on average, women in the United States live about 5 years longer than men. While both men and women are living longer than at the beginning of the last century, a gap remains. In the US in 2023, the life expectancy for men was 75.8 years. For women, it was 81.1 years. So women outlive men by 5.3 years on average. And that data is from life expectancy at birth, 1900 to 2023. So that's interesting. It's part of usafacts.org as of March 21st, 2025. Other studies highlight that many of those extra years are spent managing health issues. Women on average are living longer and also living more with chronic conditions, which can increase the need for ongoing healthcare and caregiving support. While longevity is good news, it has clear financial implications, especially for women. Retirement and investment strategy needs to support a potentially longer time in retirement, possibly 30 years or more. Healthcare expenditures may rise as you reach your 70s, 80s, and 90s. Periods of reduced work or caregiving long before traditional retirement could impact your earnings and asset accumulation. Are there financial considerations that can help support a longer life? It's a good question you should be asking. Financial strategies should account for the possibility of living longer. When helping our clients create wealth management, retirement income, and estate strategies, life expectancies are always part of the discussion, especially the extra years women are expected to live. Here are our 3 approaches that may be helpful. Number 1, assume you will be around until at least 95 on paper. Even if you don't expect to live that long, it is much easier to adjust if you have too much money late in life than if you have too little. Number 2, consider separating your portfolio into time horizons. So a near-term bucket for the next 5 to 10 years of spending, a longer-term bucket, and then a specific healthcare extended care bucket, which is really long-term. Number 3, stress test your strategy. Discuss with your financial professional historical estimates and simulations of how your strategy may hold up if you live longer than expected. If healthcare costs are higher than average or if investment returns are lower than the long-term assumptions. So, how can living 5 extra years really affect investment portfolios? Even a modest extra period can mean funding tens or hundreds of thousands of dollars in additional living and healthcare costs. That could mean having a thoughtful risk management approach that considers some growth rather than becoming overly conservative too early. I'm seeing a lot of that as we address that issue of longevity. People are staying a little more aggressive longer to let those assets grow for them over time. All right, the number 45, the share of investable assets women are on track to control by 2030. So, one study suggested that women may control as much as 45% of all investable assets in the US and Europe by 2030. Estimated growth of women controlled investable assets in the trillions. So, this is from McKinsey and Company, May 8th, 2025. 2018, that number was 10 trillion. By 2023, that had jumped to $18 trillion. And then by 2030, that number's going to jump again to $34 trillion of asset control. This estimated doubling of women-controlled assets is being driven by interrelated social, economic, demographic, and cultural trends. Much of the asset shift is expected to be attributed to the great wealth transfer underway from baby boomers to younger generations. Some estimates indicate that as much as 70 to 80% of the coming $83 trillion wealth transfer will accrue to women, not men. At the same time, income patterns continue to change for women. So, according to the Pew Research Center, 16% of opposite sex marriages had wives as the sole or primary breadwinner, about triple the share from 50 years ago. In 29% of marriages, both spouses earn about the same amount of money. In a major change, just over half, or 55% of marriages, have a husband who is the primary or sole breadwinner, down from 85% in 1972. In 2023, 45% of mothers were breadwinners, either single working mothers or married mothers who earned at least half of their family's income, with another 24% considered co-breadwinners. Simply put, in today's world, women are increasingly the ones earning, inheriting, and ultimately directing family wealth, and that shows no signs of changing. Unfortunately for men, we want men to make money and do well, but the world is different than it used to be back in the 70s and 80s and 90s. What does this mean for financial strategies? For women already managing a portfolio or expecting to inherit one, this trend is not abstract. It raises important questions for both single women and married couples looking to the future. Here are just a few. So, for single women or those who may become widowed, there's a clear, documented investment strategy that reflects their unique goals, time horizons, and comfort with risk. Or is there a mix of accounts that grew over time without cohesion? If a woman is a primary or co-earner, is the personal financial strategy built around her income, her partner's income, or both equally? Do estate documents and beneficiary designations support the surviving spouse being able to direct wealth to children, charities, and future generations? What are the 3 financial strategy moves to consider? So, as financial professionals, we typically encourage our woman or female clients to consider several approaches to help them pursue their financial and life goals. Here are 3. Number 1, create or update a personal investment policy statement. Spell out objectives, timeframes, risk guardrails, and how decisions will be made. This is especially important for married couples to discuss in the event that the wife will eventually be the one who stewards the family wealth across generations. Number two, consolidate or coordinate scattered accounts. Old retirement accounts, inherited assets, and taxable portfolios are easier to quantify, track, and align around a single strategy when they're consolidated. Number three, women who are the primary earners may want to right size their safety nets by confirming that insurance policies and emergency reserves are built around their income and the people who rely on it, which more and more, as you know, is becoming men needing to rely on it. Oftentimes, what I see is men have ample enough amounts of insurance, but women do not, and so life insurance, that is. What does it really mean that women could control upwards of 45% of investable assets by 2030? It means more of the decisions about investing, charitable giving, spending, and leaving money to the next generation will rest with women, often while they are still working and caring for others. Strategy could assume women are decision makers, not bystanders. And that is true. The number 59. So, the age many women face widowhood. Okay. As financial professionals, we understand that mortality is a difficult yet necessary topic to address, especially for women. While it may be uncomfortable to discuss, married women need to be both emotionally and financially prepared for the distinct possibility that they will outlive their husbands. What are some of those sobering facts around widowhood? The average age of widowhood for women in the United States is 59. Um, Pre retirees who are widowed face unique challenges. About 34% of women age 65 and older in the US are widows, rising to 58% for women age 75 and older. Nearly 700,000 women lose their husbands each year in the United States. Women live 12 to 13 years on average as widows. Household income for women can fall anywhere from 37% to 50% after the death of their spouse. Upwards of 40% of widows report not being confident in their ability to manage finances alone. Within 12 months of becoming a widow, 45% of women experience a decline in their standard of living. Half of all widows lose 50% of their household income upon the death of their husband. Widows who employ a financial professional before their loss are 90% more likely to feel more prepared. With the average time a woman aged 55 to 64 spends as a widow about 10 years, many women may shift into full financial responsibility earlier than they expect, often while still working or supporting adult children. What does this mean for a financial strategy? If you are a woman in a long-term relationship, these numbers suggest that at some point you are likely to be the sole decision maker for a family and for the family finances, even if your partner handles much of it today. The question is whether you want to learn and organize everything during an emotional time of loss or be ready beforehand. What are the 3 financial strategy moves to consider? There are many financial moves women can start making, but we found it helpful for clients to think in terms of 3 words: clarity, control, and continuity. Let's start with clarity. Maintain a current inventory of accounts, policies, legal documents, passwords, and key contacts. Check to see if they have up-to-date information. Make sure both partners know where this information lives and review it together periodically. Control. Married women should consider being a co-owner, not just a beneficiary, on key accounts where that makes sense. Both spouses should understand how their retirement income strategy works, how cash flow is generated, and what is owed to Uncle Sam, and how it may change if they become widowed. And then continuity. Married women should consider developing a relationship with a financial professional, estate attorney, and CPA, so they're not starting from scratch if they suddenly find themselves as the sole decision maker. Asking difficult questions can help drive the conversation when their spouse is present. Discuss openly with adult children or other individuals you may rely on what the strategy is in the event of widowhood. When should a woman start thinking about the possibility of needing to be financially independent? Long before they expect to be. That's the answer. The goal is not to dwell on the worst case scenarios, but to be able to step in the driver's seat if needed. Bringing it all together for women who are primary or equal earners. These three numbers do not exist in isolation. Many women who are listening to this are earning a share of their family income, accumulating assets in their own name, and likely to outlive a partner and manage wealth on behalf of children and perhaps parents. If this is your current situation, here are a few focused questions to ask yourself. Income protection. If your paycheck stopped for health reasons, could your family maintain its lifestyle and keep savings on track? Decision rights. Do your accounts, property titles, and legal documents reflect the role you already play in providing for others? And time and energy, does your financial strategy account for the emotional and practical load you carry, not just the numbers on a spreadsheet? What are some of the financial strategies that may fit this reality? Well, women who are a primary or equal earner or are concerned about having to assume full financial responsibility upon the passing of their spouse may want to consult with a financial professional and discuss your wealth management insurance needs. Think about building a career resilience fund. This is a slightly larger emergency reserve that may provide additional flexibility to change roles, start a business, or take a caregiving break without derailing a long-term strategy. So having a little extra in the emergency reserve account. Ask a financial professional about account titling. For example, would joint ownerships with right of survivorship be appropriate for certain accounts? Also consider asking about beneficiary designations and possible use of legal entities and estate considerations. So why work with someone? Why work with a financial professional on these matters? It's to help translate the three important numbers we've discussed into action. You may want to start by reviewing the following questions. If my spouse or I live to 95, what does my retirement income strategy look like? If a spouse needed to manage finances alone 5 years from now, what would need to change between now and then? And then how are we preparing for the wealth that may be inherited? You do not have to figure all of those out alone. As we saw above, as we have seen, and as you have heard, women who use a financial professional before becoming the sole decision maker are more confident with financial decisions. We're here to help our clients have the confidence to face the future, regardless of what it holds. Please feel free to reach out to us at Northbound Wealth Management if you'd like to start a discussion. I hope you found this information helpful and informative and educational in nature. So look for opportunities to improve on your financial wellness in this month of March 2026. Thanks for listening.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.